Good morning and welcome to Core Finance TV and my CEO interview. My name is Malcolm Graham Wood and I'm delighted to welcome back today for a repeat interview, Tony Durrant, who's the CEO of Premier Oil. Good morning, Tony. Welcome back.
Good morning, Malcolm. Hope you're well.
I'm very well, thank you, and I hope you are too. I think the viewers know enough about Premier to sort of shift away, avoid the preliminaries, because we'll probably touch base with all parts of the business as we go through our chat today. It's been a hell of a busy year. We didn't need any of the extra influences that you've had from the oil price and the pandemic. But you announced at recent results that your guidance has been reiterated at 65 to 70,000, I think, and that operationally, and I've said for years that certainly 2 or 3 years, your operational performance has been exceptional. Why don't you tell us what you were saying at the interim stage and how you are on track operationally?
Yes, thanks, Malcolm, and thank you for starting with that. Understandably, a lot of discussion around our capital structure at the moment, and it's good actually to also cover the assets and the operational performance, which sometimes get lost in the noise. So indeed, a challenging period operationally for the whole industry, but we have performed well. Production has continued on track. We are heading for the middle of our guidance range of 65 to 70,000 barrels for the full year. We've just completed the planned summer maintenance programs. We're back up and running at around our normal rate of 65,000 barrels a day as we speak. Looking forward towards the end of the year, we've got a busy period. We've drilled another well on Solan. That went very well. The well's complete. We've been hooking it up and we hope to start running tests on that this weekend. And all the evidence suggests that we should be able to add around 10,000 barrels a day from that well as it ramps up over the next week or so. On the Tolmount project, internally, of course, a lot of focus on that. We've gone through the construction period. The topsides and jacket are on a barge somewhere in the Adriatic heading towards the North Sea. We're awaiting the very large crane from Herima, which is due late September, early October. And the platform will be installed, therefore, in the early days of October. Immediately thereafter, the rig will arrive for the development drilling program. The pipeline is already in place. So Tolmount has been going well, and we're on track for a very significant increase in production for the second quarter of next year, net to Premier. And I shouldn't forget the exploration teams, something perhaps of a forgotten team in the midst of the pandemic. And of course, exploration isn't grabbing the headlines at a time of low commodity prices. But we've got new seismic data around the Tolmount area, around our acreage in Mexico, and particularly in Indonesia in the Andaman Sea, which the guys are very excited about. Some very large prospects in all three of those areas. And we're looking forward to working up that seismic data for future drilling in 21 and 22. So as you say, lots going on around the business.
Good stuff. I'm glad you remain confident about Solan because, as I sort of almost offensively remarked at the last conference, that the market doesn't always share confidence about Solan, but I suppose if you do 10,000 barrels a day from it, you'll be doing fine. Very pleased about Tolmount. Mexico, I personally still assuming it's going to be sold. Asia, you sort of glossed over a little bit, but still, I think there's still quite a lot there. Obviously, you didn't mention Alaska. You presumably aren't going back to Alaska.
Well, no, certainly not on the block that we drilled earlier in the year. We did find a lot of hydrocarbons, but unfortunately, gas condensate, not the light oil we hoped for. and difficult to market gas condensate from the particular location in Alaska. We've got one or two ideas in the new venture category for Alaska. We obviously learned a lot in going to Alaska, but nothing on the schedule at the moment. No.
Okay, I'm not going to mention sea lion, except because you know that I always will otherwise. But obviously, I do get a lot of inbound on that. But I'm assuming that until we get $50 plus and a little bit of a better line of sight, I think it's important for you for the midterm. But I think it's best to go straight onto the BP assets because, unless you had any comments on that, we know that there are going to be a material addition to the portfolio. Maybe there's two things. You give us the strategic rationale behind the process, which of course has been one of the reasons this whole financial process, which we'll come to in a minute. So the rationale and how you managed to get it so cheap in the end.
Yes, of course. I mean, the strategic rationale, I think, has always been there over a period of years. It's absolutely natural for us to add producing assets in the UK North Sea and utilise our big tax allowance, tax loss position against those producing assets. And there is a natural tax synergy which can add value. The BP assets have been performing very well during this transitional phase. So they've been generating above budget, actually, 20,000 barrels a day in the first half. So we're looking forward to getting them in the portfolio and accessing the cash flows, which are significant, as soon as we can do so. I can put a number on that, Malcolm, at our assumed oil prices over the next 4 years. Those assets will generate $400 million against the acquisition price on completion of 210. So the strategic logic and the valuation logic is very clear. And if I stand back a little bit and look at our UK portfolio as a whole, we're well established in Catcher. We're very much getting there in the greater Tolmount area. Andrew from BP will form another hub. We're in Elgin Franklin. We're acquiring from BP Shearwater. Those two assets are right next to each other. And those 5 hub areas will form the basis of Premier and of course, our UK business and represent some of the longest life hubs in the UK North Sea. So the UK portfolio is looking in very good shape, including the BP assets.
Good. Well, that'll be the grounding for what we're going to come into in a second. So we'll be seeing you producing the best part of 100,000 barrels a day equivalent.
Yes, I mean I hesitate, Malcolm, to put a target on our back, but the arithmetic is clear. Our current rate is around 65,000 barrels a day. We've got the Solan well, perhaps 10,000 barrels a day. The BP assets up to 20,000 barrels a day. And Tolmount, once it's ramped up by, let's say, this time next year, up to 25,000 barrels a day. So the arithmetic is clear.
Understood. Right. Let's go through the refinancing. I mean, you recently announced the huge refinancing of the debt facilities. I'd love to know some background behind that, how the negotiations have played out. I'm fully aware that that you put yourself into a position here where, this is what I would call a proper refinancing. You've done it for 4 or 5 years. You bring the rates down that you're paying and so on. So before we go on to the pricing and the underwriting, why don't you talk us through the refinancing of the facilities, why you did it and what they're going to be like afterwards?
Yes, of course. So it's probably necessary to go back to February. That's definitely. Only 6 months ago. It seems longer. You'll recall at that point that we'd announced the BP acquisition. It had been very favourably received in the market. We'd also announced an extension of the debt facilities by 2 years to 2023. And again, that had been well received in the market. And indeed, the share price was performing extremely well at that point. Post-COVID, post the oil price crash, we had to rethink bluntly because we are going to lose some of the free cash flow that we'd anticipated in 2020. We may lose, depending on the way in which oil price plays out, some of that we'd anticipated for 2021. And faced with that, it seemed to us that a 2-year extension to our debt maturities was not going to fundamentally address the balance sheet issue. And let's be open about it, the balance sheet issue has been a hangover on our share price for some time now. Yeah. So we went back to the creditor group. The creditor group formed a committee and, as you imply, really, began the process of discussing not a short-term rollover of the debt, but a more fundamental, longer-term debt refinancing. We had a bit of a haggle with the guys as to whether that was 4 years or 5 years. We ended up at 4.5. We had a haggle on the interest rates as ever, and we've ended up at 8.3, which is slightly reduced from the previous 8.8. So I think we're very comfortable with the long-term debt refinancing. And that, of course, from a debt point of view, gives us a much longer runway in which our free cash flow will help to reduce debt. And indeed, we hope, of course, in that period to get some further recovery in the oil price. What goes hand in hand with that debt refinancing, though, is getting some additional equity into the balance sheet. Premier has not issued any equity since 2009. And in that period, we've grown from 30,000 barrels a day to 100,000 barrels a day. And I think had oil prices remained at the same level as they were in February, then we were certainly hoping to get through our balance sheet issues without issuing a lot more equity, other than, of course, funding the BP acquisition. But the world has changed. We need to get both the debt side of the balance sheet and the equity side of the balance sheet back in shape. And we agree, as of course would our creditors, that some additional equity is needed in the balance sheet. So we went to our major shareholders. We walk-crossed them before the recent announcement. In principle, they agreed as well. And then the question was how to get a degree of execution certainty into that. Because, as you rightly say, it's a large equity offering given our market cap, given the size of the company. And the answer was we split the equity offering in two, effectively, 325 million to be raised from the market, including the funding for the BP acquisition. Around about 220 million of that is for BP. And then the balance is underwritten by the creditors. Now, our strong preference is that those new shares go into the hands of institutional and retail shareholders, rather than into the hands of our banks, for whom holding equity is not necessarily their long-term business. So the structure will be a firm placing plus an open offer, and that will give all our shareholders, including your retail followers, the opportunity to participate in the equity offering when it's priced. We've done our best to cater for both equity and debt side of the balance sheet. We've seen, of course, a reaction in the share price since we made that announcement. The share price has traded down to the level at which the market assumes we will price the equity. And I think that's a reasonable assumption, but it will give shareholders, both existing and new shareholders, the chance to come into the company at a relatively cheap price.
Okay, I'm afraid that throws up a few questions, Tony. And obviously, I need to ask the position about the Arcm short position, because in my view, that really loused up the situation a bit in the middle of this whole deal. And there was certainly a feeling from the marketplace, myself included, and a lot of the retail, I don't know about the institutions, but they were holding the company to ransom to a certain extent, and they were sort of expecting you to bail them out. And of course, you know, whether or not they expected that the announcement to be made, because when they were in the position that they got themselves into this, in the short position, there's no doubt that they weren't necessarily expecting a big refinancing like this. I first would like to know your feeling about that short position. And the second question that you talked about, I thoroughly agree that the debt holders saying they're going to take a lump of the equity position, again, as you, strikes me as not odd, because they'll do it if necessary to make companies stand up. But you wouldn't want them to have the last 200 or 300, of the equity, as what you might call flaky holders. So will they be tied in at all, or what's the position about that?
Yes, there is a lock-up agreement for the creditors, which will tie them in for some time, if of course the shares end up in their hands. There's a balance here between ensuring execution certainty. I think the market would rightly have been very nervous about a 500 million offering from Premier without that underwriting certainty on that portion. But as I said already, I think our hope and expectation is that we will find institutional and retail interest in the full offering, especially at the price at which the market has traded to. And can I just say that we've been pretty busy on the road. It's been August, so obviously some people have been on holiday, but the reception from both existing and some new shareholders for the plan, for the relaunch, you could almost call it, has been very good so far. And I do still anticipate a very successful offering as and when we get to pricing the equity, probably later in the month. To go back to Arcm, there is no particular new news for you, I'm afraid, Malcolm, on that. Arcm's short position is about 6.5%, but it's much more, I think, in balance with the corresponding debt position they hold. They hold a very significant part of our debt structure, something like 12 or 13%, I think. And of course, they are a hedge fund, and it's quite normal in these situations for a long debt position to be hedged by a short equity position. The size of that short is now, I think, back in proportion. And from all the conversations we've had, they've been actively participating in the creditor discussions. The economic driver for Arcm is their long debt position, which is how it should be, rather than their behaviour being driven by a short equity position.
Okay, so that leads me to ask the two questions, I guess, probably that the people all standing around you in the background that I can't see are telling you not to answer. But it's clear that the people, first of all, wanted to know, the people in the market wanted to know, why didn't you price it up at the time that you announced it all in the first place? And you mentioned that the market has brought it down to what you think the placing is going to be at, and we all gather that we take significant encouragement from your saying that the people that you've seen are clearly going to take up a lot of stock.
Let me deal with that.
Talk that through first.
Yeah, I mean, a lot of discussion, which comes first, debt or equity? Really, actually, no choice in the matter. We could not, would not have wanted to have asked our shareholders for new capital until the debt position with a short-term debt maturity in May 21 was resolved. It's unfortunate that the two couldn't have been done simultaneously, but the debt position has about a 3 or 4 week approval process. That's what we're going through now. And we'll only ask shareholders for new money once that's approved. That leaves the share price on the screen, the subject to volatility. We've seen that, of course. As I said, I think the market has traded down to the level at which they expect the equity to be priced at. Let's see what happens over the next 3 or 4 weeks as we get past the creditor consent hurdles. But I think the market has probably got that about right.
Okay, so the next question was going to be about timing. So you've got the 3 or 4 weeks you mentioned where you're going through the creditor agreement hurdles. So we could expect, as soon as that goes, so 3 or 4 weeks' time, have the equity. And as you mentioned, a firm placing with an open offer, because you mentioned the magic underwriting word, which is effectively the debtors. But if you had the decent firm placing in the open offer, retail investors would get like a rights equivalent or just an open offer? Or?
Yes, they'll get the opportunity to participate in the open offer, both at the level of their existing shareholders on a pro rata basis, but also there's a mechanism if people want to participate more than their pro rata share, to claw back from those that don't wish to participate. So we'll decide on the final allocation between firm placing and open offer, I think, nearer the time. But as an indication, to ensure that the full equity pricing is underwritten and made certain, then somewhere around 325 million in the firm placing, together with the underwriting from the creditors of 205, making up the full equity offering. And at that point, the open offer kicks in and allows existing shareholders to participate at whatever level they wish. At the same price, I should say.
Excellent. Right, time's running out. It seems like we've only been on for about 2 minutes, but we have a limited amount of time. At the end of an interview, I always say, where are you going to go from here? More importantly, for you probably is once these transactions are completed, Premier is going to look like a very different company. I'd really like you to give us an idea of where you see it all. Let's assume it's all done and there's not too much underwritten and so on, but it's all done and dusted. Where do you see Premier after this?
Absolutely, and that's very important because that, of course, is the purpose of the financing transactions that we're now doing to bridge us to a future profile for Premier. You mentioned the 100,000 barrel a day target earlier on, and as I explained, the arithmetic does get us there. And that 100,000 barrels a day will generate very significant free cash flow going forward at any oil price. I can give you a couple of numbers there, Malcolm, to help you out. Our long-term oil price after a period of the forward curve is still $65 a barrel. That's the oil price I think the whole world was working off only 6 months ago. The banks, inevitably more conservative, tend to use 55 or thereabouts for their reserve-based lending profiles. At $55 a barrel long-term, again, after a period of the forward curve, we generate $150 million a year on average of free cash flow. At $65, we generate $300 million a year of free cash flow. If you look out to 2024, which is actually the assumed next debt financing date for Premier, the current facility expires in March 25. Our balance sheet is back in shape. Debt is less than $1 billion under the $55 case, and it's down to $350 million under the $65 case. So there is a clear pathway to get Premier back into very good shape over the next 4 years through free cash flow generation. You're aware that we have a lot of oil and gas in the ground, in the Falklands, in Mexico, in Indonesia, and we have some very good exploration projects for 2021 and 22. We're going to be very cautious on reinvesting that free cash flow in those projects for obvious reasons. The priority remains to get the balance sheet back in shape. But depending on oil prices, and as we go through, let's say, that next 4 or 5 year of planning horizon, we have lots of opportunities to reinvest and to continue the growth profile that we have. So we are in an unusual situation. We're growing, but net debt is reducing once we get these financing transactions in place. And that's a good place to be.
That's brilliant, Tony. Thank you very much. You've been really open and honest today with me and with the thousands of viewers who'll be watching this and reading it in the various. I very much appreciate that, and appreciate the candor with which you're going through this whole process, and which must, as I said, sort of squeaked in at the beginning, must have almost made you wonder whether it was worth the while in the process. But I very much appreciate it. And thank you very much.
Not at all, Malcolm. You and I have been through a few of these ups and downs before in the industry, and the industry will come out of this one again as well.
I'm sure it will. Thank you very much for watching. My name is Malcolm Grahamwood. Today I've been doing a CEO interview on Core Finance TV. My guest has been Tony Durrant, the CEO of Premier Oil. Thank him very much for today, and look forward to seeing you again soon. Bye now.